Welcome back to the deep dive. So you sent us a fascinating stack of source material, all drawn from legal studies focused on a business organization.
That's right.
And we're zeroing in on one of the most fundamental choices a business founder can make: what kind of partnership structure to choose.
It sounds dry, but it's really not.
No, this is more than just paperwork. The choice, it determines how much personal risk you take on and how freely you can even operate.
Exactly.
So today we are diving deep into a head-to-head comparison between, well, the venerable old standard, the traditional partnership, established by the Partnership Act of 1890,
A very old piece of legislation.
and its modern risk-mitigating counterpart, the limited liability partnership, or LLP.
A much more recent invention for very specific reasons.
Our mission today is to cut through all the legalese and give you a structured understanding of three critical points: how they're formed, the authority held by the partners, and, crucially, the liability for partnership debts. Okay, let's unpack this.
And that framing is spot on. For anyone involved in a professional service firm, or even just thinking about setting up a venture with others, this isn't abstract law at all.
Not at all.
This is the mechanism that determines if the company's debt stays with the company, or if it pursues your personal assets. We're defining the legal line between the business and your home mortgage.
Wow.
Our sources provide an excellent structured pathway to distinguish these frameworks. They help us highlight the structural incentives and, the disincentives baked into each model.
So we're looking for those aha moments.
Exactly. The moments that explain why one model, despite its ancient roots, is still used, and why the modern version was legally necessitated.
Okay, let's start at the beginning then. The legal bedrock, the traditional partnership.
The 1890 Act.
Right. So if you just grab one or two other people and decide to carry on a business together, with a view to profit, you've likely just formed a partnership under this act.
That is the essential definition. And what's fascinating about the 1890 Act is its simplicity. It really prioritizes the operational relationship over any kind of formal registration.
There's a catch.
A huge one. That simplicity comes at a devastating cost. And if you only remember one thing about the PA 1890, it's the nature of its liability.
And that nature is, famously, unlimited.
Precisely. Under the PA 1890, partners generally face unlimited liability for all partnership debts. This means that legally, the partnership isn't a separate entity from its owners.
So there's no distinction.
None. It's merely a collection of those individuals. So when the business runs out of money, the legal shield dissolves instantly because there was no shield to begin with.
Can you give us a real-world example of what that kind of unlimited risk looks like in practice, let's say in a high-stakes scenario?
Of course. So imagine three partners running a consultancy. They're jointly responsible for let's say, a £500,000 bank loan. If the business hits hard times and declares insolvency, the creditors are entitled to pursue the personal wealth of all three partners. But what's really critical here is the concept of joint and several liability.
That's a key legal phrase that definitely needs clarification. What does joint and several actually mean for a partner's personal bank account?
It means that creditors don't have to change all three partners equally. They can choose to pursue the partner with the deepest pockets, the one with the most substantial home, or the largest savings for the entire £500,000 debt.
The whole amount, from just one person.
The whole amount. That partner is then left to try and reclaim the shares owed by the others, which, as you can imagine, is often impossible if those partners are also insolvent.
So the risk isn't just shared.
It's concentrated on the most financially solvent individual. It's a mechanism designed entirely to protect the creditor by making the partners the ultimate guarantors of the business.
That is a staggering operational risk. Knowing that level of exposure, it just begs the question, why would anyone choose this structure today?
Because there's an upside to that informality, especially for small, highly trusting ventures or, those with very low financial risk. It's fast, it's cheap, and it requires almost no formal statutory compliance to start.
So speed and freedom.
Speed and freedom are the lure, but you are trading that for personal safety every single time.
And that fundamental tension, that unlimited personal risk from the 1890 Act, is exactly what drove the creation of the modern alternative. Here's where it gets really compelling.
Right, the solution.
This is where modern legal frameworks step in to solve that century-old problem of risk transfer. We're talking about the limited liability partnership.
The LLP. It's a really elegant structural solution, actually.
Yeah.
It was specifically created to offer the best of both worlds.
Which are?
The operational and tax flexibility you traditionally associate with a partnership, combined with the core protection of a limited company.
And the core protection being that liability shield.
Exactly. The fundamental legal benefit of the LLP is that it creates a separate legal entity. This is the whole game. Unlike the 1890 partnership, the LLP exists in law as its own person, completely distinct from the partners who run it.
So if the LLP incurs debt or faces legal trouble,
Those obligations belong solely to the LLP itself. The partners, in their capacity as partners, generally enjoy limited liability. Their capital contribution to the firm is at risk, yes, but their private home, their personal investment portfolio, they're shielded from the firm's general business
that
debts.
is a huge difference.
It's a necessary evolution for high-risk, capital-intensive, or just large-scale professional practices.
So if we go back to our example, the LLP takes out that same 500,000 pound bank loan and the business fails. The creditors have to stop at the LLP's assets.
That's the principle.
They can't cross that legal boundary to seize the partner's personal property the way they could under the 1890 Act.
That is the principle, yes. Now, there are always caveats. Limited liability is a shield against firm debt. It is typically not a shield against a partner's own professional negligence or, say, fraud.
Ah, okay, that makes sense.
If a partner personally commits a serious error, they can still be sued personally, even within an LLP. But for the general commercial debts of the business, the shield holds. And that separation of the entity from the individual, it just fundamentally changes the risk calculation.
Okay, now that we've established that foundational difference in risk, let's drill down into the specifics from the source material. We'll start at the entry gate. Comparison point 1, formation.
Right. And formation is the first major point of divergence. It reflects that core trade-off we just discussed, speed versus protection.
Let's start with the traditional approach. How simple is it to form a partnership under the PA 1890?
It is remarkably, I would say almost dangerously simple.
Yeah.
As long as you have two or more people engaging in a business for profit, the law just deems a partnership to exist,
Even if you didn't mean to.
even if unintentionally. You don't need to register anything publicly. You don't even need a written agreement, though one is highly recommended. The law can just look at your conduct sharing profits, making joint decisions, and simply declare that a partnership exists.
That's amazing. You can literally create this high-risk entity by accident.
Precisely. Now, contrast that with the LLP. If you want the immense benefit of limited liability, the law requires you to earn it through deliberate formality and public documentation.
So you have to be intentional about it.
Very. An LLP must follow a stringent legal process. It requires formal incorporation, including specific registration with the relevant government registrar. This is a public process. It involves filing incorporation documents and a formal LLP agreement.
And if you don't register,
No registration, no shield. The cost of entry, both in time and legal fees, is significantly higher, but it's the non-negotiable price for that corporate-style protection.
so the traditional partnership is like the legal equivalent of a handshake agreement, whereas the LLP requires you to, what, stand up in front of the public registrar and declare your existence and intent.
That's a great way to put it. And it's that public act of registration that grants the limited liability. The bureaucracy is the gatekeeper to the low-risk environment.
Okay, let's move on to the operational side. Comparison point 2, the authority of partners. This defines how much power one partner has to legally bind the entire firm.
And this is where the high trust requirement of the 1890 Act truly manifests. It is perhaps the greatest operational risk in a traditional partnership outside of, actual insolvency.
Why is that?
The 1890 Act operates on a very broad concept of inherent agency. The law treats every single partner as an agent of the firm and of their fellow partners.
An agent meaning.
Meaning if a partner performs an action that appears to be in the ordinary course of the business, the firm and all the other partners are automatically bound by that action.
Even if they didn't know about it.
Even if they explicitly told that partner not to do it, or if they were completely unaware.
Okay, another example. Let's say we are 3 partners running a bakery, and one partner secretly signs a 10-year extremely high rent lease on a new, unneeded space across town.
A classic scenario.
Are the other 2 partners now financially liable for that entire lease?
If taking out a lease is deemed to be within the scope of running a bakery business, then yes, absolutely. If the landlord was unaware of any internal restrictions, that transaction is binding on all partners under the principle of apparent authority.
So you're staking your house on the good judgment of your co-partners.
You really are. The unlimited liability of the 1890 Act, combined with this broad agency power, is why operational trust in a traditional partnership must be absolute.
It's a critical detail. So how does the LLP structure mitigate this inherent agency risk?
Well, the LLP framework still allows partners to manage the business flexibly, but the relationship is just structured differently. It often provides much tighter controls over individual actions.
And how is that achieved?
Through the formality required of formation. Because the LLP agreement must be filed, it typically details specific restrictions on partner authority for major transactions, say anything over £50,000 or taking out new loans.
Ah, so it's all written down.
Right. And furthermore, LLPs often designate designated members who carry specific statutory, administrative, and compliance burdens. This provides a clearer hierarchy and oversight structure that is enforceable externally.
So while the traditional model relies on this implicit, broad agency, the LLP model encourages specific contractual constraints defined right up front.
Correct. So if a partner in an LLP tries to sign that massive, unnecessary 10-year lease, their co-partners can point to the formal internal agreement to argue that the partner acted outside their constrained authority.
It gives them a defense.
A much clearer defense against a rogue partner than the 1890 Act ever could. The LLP's strength is in its defined statutory boundaries, whereas the 1890 Act's strength is, well, it's boundless informal trust.
Okay, we've built up all the components, so let's bring it home. Comparison point 3, liability for partnership debts. So what does this all mean when the worst-case scenario hits?
It means the legal framework acts as the ultimate filter for financial pain.
How so?
Under the PA 1890, the law sees the business and the people as one and the same. This results in that devastating joint and several liability we talked about. The focus is ensuring the creditor gets paid, even if it requires stripping the personal wealth of the most solvent partner.
The partners themselves are the ultimate guarantor.
They are. And the LLP, by creating that separate legal person, shifts the burden of risk completely.
It's a total paradigm shift.
It is. The LLP framework is designed to mimic the corporate protective mechanism. By requiring formal registration and compliance, the LLP grants its partners that shield. It ensures the firm's general debts remain locked inside the entity, protecting the partner's private wealth.
It is extraordinary to think that two business forms, both called partnerships, could have such wildly divergent consequences for the people involved.
It really is.
The key distinction for the learner is that trade-off. Speed of formation and inherent agency in the traditional partnership versus required registration and the priceless asset of limited personal liability in the LLP.
And that trade-off is often reflected in the type of business that chooses each model. The PA 1890 is often favored by small, trusted family businesses or low-risk ventures where compliance is just burdensome. The LLP is the default for high-risk ventures or large professional firms where the sheer scale of potential liability demands that protection.
So to sum up this deep dive, you now have a clear structure for comparing these two frameworks. The traditional partnership offers informality and broad agency, but you pay for it with unlimited personal exposure.
Right.
The LLP requires formality, statutory registration, and defined constraints, but in exchange, it grants the invaluable protection of limited personal liability. The source material really did provide an essential structured view of how legal accountability is structured in modern commerce.
Absolutely. Yeah. And the decision between the two is a direct calculation of personal safety versus administrative simplicity. We've defined the structural differences, but let's connect this to a broader question about regulatory oversight.
Go on.
This raises an important question you should carry forward. If the law grants the shield of limited liability, what is the regulatory price tag? What extra public duties or stringent oversight rules must exist within the LLP structure to protect creditors and the public?
Duties that just aren't necessary in the old model.
Exactly. They're unnecessary in the unlimited liability model because the partners themselves act as the ultimate personal financial guarantor. This focus on risk mitigation for the partners forces a corresponding increase in legal scrutiny on the business itself.
A perfect thought to take with you as you navigate the risk landscape of business organization. Thank you for joining us for the deep dive. We'll see you next time.